Hello, this is Eric Merritt from Eric Merritt Sells AZ Real Estate, Realtor of HomeSmart Northeast Mesa. This video today we're going to talk about debt to income ratio and why it is so critically important to understand what your DTI ratio is before you attempt to even start getting more serious about looking at homes, so that way you know what you have to work on, you know what your debt to income ratio is now, and then you know what you have to do in order to get it fixed and get it adjusted so that you can qualify for a conventional loan, if that's what you're trying to do, or even just to qualify to buy a house. So if you find this video informative, please go ahead and hit that like and subscribe and share this video with your friends or anyone that you think can benefit from it, and we'll get this video started. Thank you. So our video is going to talk about debt to income ratio and why it is so critically important to know what that is before you even talk to a loan officer. So this video will clearly demonstrate how debt to income ratio can be very important to get the type of loan that you're looking for, and thus lead you to the type of house that you're looking for. So debt to income ratio is defined as the total amount of revolving debts divided by the gross monthly income before taxes. So revolving debts include things like your future mortgage payment, whether it's a single family detached or a townhome or a condo, car or truck payment, total of all minimum credit card payments, so that's the revolving minimum amount that you have to pay. So all the credit cards that you have take all the minimums that you have to pay, and that's what loan officers use to determine DTI. Student loans, 1% of the balance, especially if it's deferred. Child support payments, furniture payments, and appliance payments, etc. Those are all debt payments that recur month after month. So here's some examples: car payment, student loan debt payment, credit cards, and then of course the future home. Examples of debt to income ratio. So we're going to have 5 different examples that we're going to go into for debt to income ratio. The first example is someone that's making $6,000 a month or $72,000 a year before taxes. Monthly debt payments include a future home of $1,850 a month based on a $325,000 house. Car payment $600 a month, credit card minimums $500, and appliance payment like a refrigerator or washer and dryer $200. So that totals $3,150 in monthly debt payments. Divided by $6,000 in a month is 52.5% debt to income ratio, or DTI. So with an FHA loan standard, that still qualifies. For FHA D.T.I down payment assistance grant, it does not qualify because that's over 50%. FHA loan standard maximum is 57%. Conventional does not qualify either because conventional cuts off at 45% in most cases. A VA loan can go up to the same 57 to 60%, which is very high. It does qualify for that. So in the second example, we'll consider someone or a couple that's making $6,000 a month, $72,000 a year before taxes, and paying off all credit cards and the appliance to remove the monthly revolving payments. But we do not cancel the credit cards. So monthly payments are now $1,850 for the house, $600 for the car payment. So it's $2,450 in total debt payments divided by 6,000 gives you 40.8% DTI ratio. So that qualifies on all counts. FHA standard, it's well below 57%. USDA, it's below 45%. USDA has 100% down, 100% grant, but it's only available in certain specified areas like Coolidge and Florence and maybe some pockets of Casa Grande. I did check Maricopa. It's not available in Maricopa, and I don't think it's available in Queen Creek or Santan Valley anymore because those are much more heavily populated than they were 5 years ago. There were pockets in Queen Creek and Santan Valley where you still could get USDA, but not anymore. FHA DP 50% qualifies, and conventional 45% definitely qualifies. It's in the third example, we have someone that's making $5,500 a month or $66,000 a year before taxes. So let's do this one in reverse and take into account the desired debt-to-income ratio has to be at 50% or lower. So I took it at 48%. I took 2% out to make room just in case an interest rate goes up from 2.85 to 3.5. So I calculated in this case if the interest rate did go to 3.5%, you still would qualify. So in this example, monthly payments, car payment $600, credit card minimums $400, and what's the house payment? So $5,500 times 48%, 0.48 equals $2,640 in total maximum debt payments. So $2,640 minus the $1,000 in debt payments we have over here equals $1,640 is what the maximum house payment can be if we did nothing with these things. So this equates to a home that's worth about $280,000 on an FHA 3.5% down payment, 2.85 interest rate, $2,000 in property taxes, and $80 in HOA per month as of June 4th, 2021. So I've put in the property taxes at $2,000 and then the HOA higher at $80. So in case the property taxes are lower, like $1,700 or $1,600 or $1,500, then you're coming out that much more ahead. I like to overestimate my example numbers so that it's better for you if I overestimate. So when it actually does happen, then it's better for you so you can clear on the debt to income ratio. Example number 4, a couple makes $84,000 a year, $7,000 per month, and wants to get a conventional loan, which is at 45% debt to income ratio, D.T.I. So card payments over here. This example, $600 for the card payments, $400 for the cards. Child support, we're adding in $500. So what's my house payment? So you take $7,000 times the 45% debt to income ratio to qualify for a conventional loan, the Home Ready and Home Possible, or any other conventional loan. There's $3,150 maximum debts per month. So $3,150 minus $1,500 that you have over here is $1,650. So at $1,650, that house equates to the very similar price that we had in the last example, around $280,000. Now, however, if I want to have a house that's $350,000 because I want more square footage or I want to be in a better area, so the home's going to be a little bit more expensive, how can I lower my debts to qualify at a house at this price? So at $350,000 house in this example is going to be based on 3% down conventional, 3% interest rate, 0.85 mortgage insurance monthly, property taxes at $2,200 per year, and $80 a month HOA. I added a couple more $100 for the property taxes because property taxes do go up when the price of the homes go up. So that equates to a 2022 $66 monthly payment, $2,022.66 payment. So taking that into account, $3,150 maximum debt allowed minus $2,022.66 is $1,127.34 maximum other debts allowed. So this makes it, if you add it here, it's $2,022.66, $500 for the child support, $600 for card payment, and $400 for credit cards. That's $3,522.66. So the way that, the D.T.I ratio in this example is 50.3%, does not qualify. That's the debt to income ratio here. But since we want that $350,000 house, we need to be, and have conventional loan, we need to be at 45%. So $3,150 would be the max. So if you just pay off either a credit card payments or a card payment, pay off the car or pay off the credit cards, but don't close the accounts, just pay them off, then you will qualify. So in this example, I'm taking the credit cards, subtracting $400 from the $3,522, that's $3,122.66. Divided by the $7,000 gross monthly income is 44.6% D.T.I ratio. Qualifies conventional. That's wonderful. Great. Conventional loan. instead of FHA, because with conventional, at least you have a chance to get under contract. With FHA, a very small number, less than 20% of the contracts in the Phoenix metro area are getting under contract right now. The conventional is just over half, and cash is around 25-27%. So we need to get a conventional loan if we're going to play in the game to buy a house in this 4,500 to 5,000 active inventory market. So since it's much harder to get rid of child support, there's other ways that you can go about it that'll be easier to get rid of, to lower the debt so that you can get the debt to income ratio that you need to have. Here's an example of the Home Ready, Home Possible example. Home Ready and Home Possible are 3% conventional down payment programs available from Fannie Mae and Freddie Mac. They have the following criteria. Maximum income is $62,500 per year, or $5,208.33 per month gross. With this program, you can get similar low interest rates as someone with a 740 FICO with only a 680 or a little bit higher FICO. So you can get the upper twos rate in conventional, or 3%, based on whatever your D.T.I, based on what your income is or other factors. And debt to income ratio is maxed out at 45%. So the benefits versus an FHA, like I said before, higher probability of getting under contract and much less mortgage insurance than an FHA loan. So this example over here, I put it at the highest that you can. So someone in a couple makes $5,200 a month, has $200 in credit card revolving payments, and a $400 car payment. So $5,200 times 45% is $2,340 total maximum debts allowed. $2,340 minus $600 is $1,740. That is exactly a 45% debt to income ratio. So that $1,740 maximum mortgage payment equates to around, if an $1,850 equates to $325 and $1,650 is about $280,000, then that's going to be about $300,000, $300 to $305 amount house. But if you wanted to go all the way up to, you could, $2,340, you would have to have no car payment, no debts of any kind, and then you could do the house. However, based on whatever you take home per month, you have to consider, is it really feasible for me to pay 50% of my income, my take-home income, to a house payment? If you do that, that's a little bit dangerous. I wouldn't do it. I recommend for someone to pay for a house payment or housing in general, 35% of your take-home income is what I recommend. But if you can do it and do it higher than that, then that's great. For a workout for you, that's good. Just go through your budget and see how you can do it, or how both of you as a couple can do it. Because I know people that have had a 57% D.T.I on an FHA, and then they sold their house 2 years later, got money, got enough equity, bought their second house, and now that second house is appreciated probably around $100,000. So it can work. So in conclusion to this video, when calculating your debt to income ratio, please remember that it's taking all your total revolving debt payments divided by your monthly gross income. Revolving debts are not your car insurance payments, utility bill, cable bill, cell phone, or your internet provider. So if you need any assistance in calculating that, your debt to income ratio, you can please send me a text or call me at 480-999-6061. You talk to any of my 3 loan officers that I do business with, and they can definitely help you with that. So remember to look at what the formula is for debt to income ratio. And if you find this video very interesting and you can get some things out of it, you may have to watch it a couple of times to fully understand the math, but it's there. So if you please find this video interesting, go ahead and hit that like and subscribe button, and share this video with your friends or anyone else that you know that may benefit from it, and you'll be notified of future videos as well on the channel. And I appreciate you watching, Thank you very much and hope to do business with you. And if you're working with another realtor, make sure that your realtor understands the debt to income ratio so that you're not being shown something that is way too heavy based on what you make. So thank you very much.